Okay, so hello and welcome to our latest urgent market update video for Friday the 13th of December. Now, we were waiting on purpose to get this video out post what was quite an important week for news, but only really as of Wednesday and yesterday, Thursday, the 12th of December. So we'll review the news, we'll have a discussion, we'll have a look at the charts, we'll identify what our directional bias is prior to this event, but also what the news that's been released, what does it suggest about future price moves, and we'll hopefully leave you with a bit of a broad understanding in terms of what we can perhaps expect over the course of next week. So if we can start, as we always do, with our risk warning, take a brief moment to familiarize yourself with our risk warning currently up on screen. Do feel free to pause the video if you need. And let's get straight into it then. So we'll break down these news events for you. Starting on Wednesday, December the 11th, there was very little news Monday and Tuesday of this week. However, Wednesday afternoon, we were watching very, very carefully these major news events. And the first one was US inflation. And what you can see in here is a gradual increase in inflation in the US. Now, the reason why that's a problem for the Fed is that they're in the process of cutting rates while inflation is actually ticking a little bit higher. Nothing outrageous. When we do get these little bumps, the Fed referred to them as bumps in the road. So it's a steady decline down to 2% with a couple of sort of peaks and troughs in there as well. So as far as the Fed are concerned, and the markets are certainly giving a green light to inflation, although it's bouncing off its lows, it's heading in the right direction, let's say, for now. So with regards to inflation, and this really means if the market takes this inflationary bounce seriously, then it would have a major impact on equity prices. But the market is not taking this information that seriously. It's also rubbishing the Trump effect. It's not really taking that into consideration either. So Trump policies on immigration is quite inflationary. Tariffs is quite inflationary. We also know that he is preferring the Fed or the FOMC to continue to cut rates to accommodate the economy to a much greater extent, along with his tax cut proposals, which all of these events are inflationary in nature, not to mention the retaliatory trade war type dynamics that we saw in the first 4 years of Donald Trump. Will that sort of take over and dictate to these markets moving forward? It's very, very likely to do so. So although there's this air of euphoric sort of aggressive buying, you also need to take into considerations the risk, which you can see across the bond markets, for example, which are suggesting that actually risks are beginning to build again. Okay, so in addition to US inflation, we've also got Bank of Canada. We've saw a very significant 50 basis point lowering of the Canadian interest rate from 3.75 to 3.25. So that feeds into this dovish narrative. In addition, we had another 50 basis points, but this one's a bit more of a surprise for these markets from the SNB, the Swiss National Bank. Previously at 1%, we were expecting a 25 basis point rate cut. And we actually saw, again, a really dovish, and it's important to keep that phrase in mind. There's a dovish reality for these central banks as things currently stand. So they're in the process of cutting rates. Then we move on to the ECB, and they also cut 25 basis point. So we've had this post-COVID rally in bond yields, a lot of moving sideways up at the highs over the last number of months, and now we're embarking on a rate cutting cycle. So these are the market cycles in real terms. Now, another spanner in the spokes for the US, which it's currently glossing over, and we'll have a look at the charts in a minute to show that indecision. But we're actually seeing input costs increase slightly, especially in the headline PPI numbers. Previously 0.3, we're expecting actually to come in lower at 0.2. Actually, we saw a number of 0.4. So then we blend in, we add in unemployment claims into the mix, and we're expecting 221,000 unemployment claims, and we saw 242. So that's a 21,000 increase in unemployment claims for the US. So it suggests that there is this weakening there that's sitting underneath the hood, so to speak. And then we had I suppose, a meeting by meeting, but quite a dovish view from Christine Lagarde in her press conference. And that lends itself to certainly a weaker euro. Not just a weak euro, but also a weak Swiss franc, a weak Canadian dollar. And we're seeing the Aussie and the New Zealand turn very, very weak as well, along with the pound and the yen. So really, it's a week of dollar strength. And that's only really reinforced by some of these news events this week, with the Fed perhaps struggling to cut rates as aggressively as other central banks. It creates that interest rate differential, which you'll see on the left-hand side of your screen. So you've got the UK and the UK and the US still at 4.75, with other central banks in the process of cutting. How quickly will the US be able to cut significantly? Probably not. Whereas the other central banks, the RBA, the BOC, the ECB, the SNB, and the BOJ, they've all got very, very different dynamics to deal with. We then throw in UK GDP, and we've got 2 back-to-back months of negative GDP numbers for the UK economy. So concern perhaps for the UK economy moving forward in terms of whether this recession is actually already in play, which is a reality, unfortunately, for these markets, that we're actually, if you look at some of the economic data points, it looks like we're already in recession. If you look at others, you really have to question what recession. There is no recession, with asset prices rallying to all-time highs. So these are the news events of importance. So let's show how that has manifested itself in these financial markets. And what I'd like to do is to just show the direction of travel prior to this week's news. And I'll do the same for, oops, sorry, let me change this over. So we've been really moving sideways in the indices as well. So that has been the overall direction of some of the largest markets in the world, from the S&P 500 top left, in the middle here, the German DAX, which is still making new all-time highs, despite the weakness in the German economy and the Eurozone as a whole. Crude oil, top right. Bottom right is the Aussie dollar. In the center here is the pound dollar, and also the euro dollar, bottom left. So we've had really purposeful directions in these markets up till now. And this news, the market was pretty much expecting a little bit of a market response. And I suppose the question is, are we actually getting the market response perhaps that we were envisaging? And the answer is probably not. If you look at the euro dollar in here, we've been consistently moving sideways. So this is the reality for these financial markets as things currently stand. Is that, where do we expect these markets to go? Well, if we start to sell off, then there's a bit of a sell trade across these indice markets. For crude oil, if we start to break below the $66 level, then you're expecting further downside. The Aussie, the overall continuation trade is very much low. We're still in this trade to the downside, and we're also still in the pound dollar as well, expecting further downside, perhaps down to these recent lows. And unfortunately, the same dynamic applies to the euro dollar, where although we've been in a bit of a sideways moving pattern, if we do break below this support and resistance level almost, then our expectation in the coming perhaps few days is more likely to be to the downside. Now, you have to take into consideration that the market dynamics we've seen in the indice markets, and this could reverse very, very aggressively and start turning, still see further upside. So you've almost got a bit more of a question mark over the indices, a bit of a question mark over crude oil, but the dollar seems to be one of the areas where not just were we able to benefit from some decent trades. This week we're looking to continue that going into next week, and we'll close out the year, and certainly early next year, the bias would certainly be still to the upside for the US dollar. So just bear this in mind. And I suppose the reason why we've got these blue consolidative support and resistance boxes is because we would have expected a bit more of a market response off the back of this week's news, US inflation, and all the news events that we've already discussed. And we're yet to get the move. So the move might prove really quite significant when we get some follow through. Now we're getting a bit of follow through just more recently in the pound dollar. The Aussie dollar is beginning to turn a little bit more bearish, and we're yet to see some continuation now today, following yesterday's quite bearish market dynamics. So that's just a little review of the news and a little review of the charts, just to show, what are we looking at in the coming weeks and months. Just a little sort of follow-up really from the election of Donald Trump. We were in two minds as to whether, if Trump was elected, whether the indices would rally after Trump trade or whether it would contract because of all the inflationary policies and the fact that the Fed wouldn't be able to cut rates and it would be more expensive to refinance debt, and the economy would start to slow and all these sorts of things. So we've clearly had a bit of a strong rally in the indices still, and probably will till the end of this year. But this is where our analysis going into Donald Trump would be that it would have a net positive impact on the US dollar. We would see bond yields rally. We'd see the gold make reasonable attempts to move higher, and it would have more of a positive impact on inflation. And we've seen these four elements, materialize over the last 2 months, or 7 weeks now. And we can only really see this type of dynamic continuing with, unfortunately, a bit of a big question mark over the US indices. So just a little bear that in mind, and a little bit of an update with regards to how things progressed since we've seen Donald Trump get into power. Okay, so that just about concludes then this very short video. If you do have any questions, do feel free to email us at support@thelivetraderoom.com if there's anything you want to discuss in a bit more detail about anything covered in this short video. So all that's left for me to do now is to thank you very much for joining us. We hope you stay tuned for our next video. We do have the FOMC next week, so we will be very likely to get another video out around that. So bear that in mind. And if you are interested in learning how to trade, you can access one of our live trading and education bundles on the website, starting from just $59 per calendar month. So just go to thelivetraderoom.com for more information and connect with us through our website if you do have any questions. So on that note, we let you go. Thanks for joining us. We'll see you next time. Bye for now.